What's the default setting for your registered retirement savings plan when you pass away? The default rule is that the entire fair market value of your RRSP is considered income paid out to you right at the moment of your death. This means it all gets slapped onto your final tax return, and that can create a massive and often totally unexpected tax bill for your estate. Let's take a closer look at this default rule and see why it can be such a financial gut punch. First up, a quick bit of lingo you'll see in the official paperwork, the annuitant. Don't let it throw you off. It's simply the official name for the person who owns the RRSP. So if it's your RRSP, you're the annuitant. Simple as that. So the general rule, as the source material puts it, is that upon the annuitant's death, the RRSP is collapsed. The government treats its entire fair market value as if it were all cashed out and handed to the deceased in their final year. Let me put that in perspective. Imagine an RRSP worth $300,000. That entire $300,000 gets added to the person's final income tax return. This can easily push their estate into the highest tax bracket, meaning the tax bill on just the RRSP could be well over $130,000. A huge chunk of those savings, just gone. And this just lays it out so clearly, doesn't it? The two paths. On the left, you've got the default. A huge slice of the savings is just lost to taxes. But on the right, you have the rollover solution, where the tax payment gets kicked down the road, the full value is preserved, and the money gets to continue growing tax-sheltered for your loved one. I mean, the difference is night and day. Okay, now that we've seen the problem, let's talk about the solution. And this brings us to the most important exception to that general rule, the spousal rollover. It really is a powerful tool, a financial lifeline designed to prevent that huge tax hit. The concept itself is actually pretty straightforward. Instead of the RRSP being cashed out and taxed to oblivion, it can be rolled over directly to a qualifying survivor. This means the tax is deferred. The government essentially allows that tax-sheltered status of the money to continue just under the survivor's name. Now, what's really important here is how specific the rules are. There are two crucial conditions. First, the spouse or common law partner must be named as the sole beneficiary, either right in the RRSP contract itself or in the will. Second, the actual transfer of the money has to be done by December 31st of the year following the year of death. You have to meet both of these conditions, no wiggle room. Now, while the spousal rollover is definitely the most common, it's not the only game in town. The rules also make room for other dependents who are relying on the deceased for financial support. They use this term qualifying survivor, and this can include a child or a grandchild who is financially dependent on the deceased annuitant. You know, this is a really important provision, especially for single parents or for grandparents who are the primary caregivers. For these other qualifying survivors, the funds can be moved to a bunch of different registered plans to keep that tax-deferred status going. It could be their own RRSP, a RIF, or in certain cases, a registered disability savings plan, or even used to buy an annuity. The key thing is, you're just moving it from one registered container to another. Okay, so we know what a rollover is and who qualifies, but how does it actually work? Let's break down the paperwork. It can seem a little intimidating, but it's really a very logical, step-by-step process. Okay, stay with me here. This is how it works. The survivor will get a T4 RRSP slip, which makes it look like they just received all this money as income, and they actually have to report that full amount on their tax return. But, and this is the magic part, once they contribute that same amount to their own eligible plan, like an RRSP, their financial institution gives them a receipt. They then use that receipt to claim a deduction that completely cancels out the income they just declared. So the income and the deduction wash each other out, and the result is zero tax paid. Pretty clever, huh? Timing here is absolutely everything. Let's look at this timeline. If the death happens in 1 year, the beneficiary has until December 31st of the next year to get the transfer completed. This is a hard deadline. Missing it could mean losing the ability to do the rollover and, well, you're facing that big tax bill we talked about at the start. We've covered a ton of ground, from the default tax hit all the way to the step-by-step process of the rollover. So let's just boil this all down to the most important thing you need to remember. I find this analogy really clicks for people. The RSSP is like a special tax-deferred container. The rollover isn't about giving cash. It's about carefully handing that protected container over to your beneficiary so the savings inside can stay sheltered and keep growing for their future. So here it is, the crucial point. None of this is automatic. This amazing tax deferral strategy is only possible if you've done the work ahead of time. Having a clear, correct, and up-to-date beneficiary designation on your RRSP account is what unlocks this entire process for your family. Without it, your estate is probably going to face the default rule. And that really brings us to our final question, a question for you. Don't just assume it's all taken care of. Life changes. People get married, divorced, have children. A beneficiary you named 10 years ago might not reflect what you want today. So take a moment after this. Check your paperwork. Is it clear? Is it correct? And does it protect the legacy you've worked so hard to build?